Bloomberg Audio Studios.
Podcasts, radio, news.
Let's bring our first guest on the Asia trade. Paul Krugman is, of course, Nobel Laureate and Professor of Economics at City University of New York. Professor Krugman, it's a pleasure to have you with us on this first episode of the Asia trade. I wanted to start off with the US economic outlook because I know recently you've written about this idea of inflation brain, right? The idea that, you know, perhaps price pressures are the scapegoat for all economic afflictions in the US. The balance of risks for the Fed and a lot of other central banks, including the RBA, for example, and the RBNZ, seem so fine at the moment. What would make you suggest that they should go for a small cut in June? Okay,
the first thing to say is that we are pretty sure. The recent inflation data have been, you know, there's noise, there's probably some funny stuff with seasonality, but basically inflation has been beaten. You know, we're arguing over whether underlying inflation is 2.6 or 2.1%. We're not. The range of disagreement there is fundamental disagreement is really small. We're basically there, and the big uncertainty is how long can the economy continue to, you know, power along with rates this high, and we're at this point now where there are just, you know, faint hints, soft data suggesting that we're starting to lose steam, that consumers are starting to falter. It's nothing drastic, but then it never is at this point, and if you're beginning a downturn. So it's, you know, the chance of reaccelerating inflation looks very small if the Fed cuts rates. The chance that they will look back and say, my God, why didn't we take at least a little bit of precautionary action against a looming downturn looks very much larger. So I would go for the rate cut, if only to signal, hey, you know, we're not asleep here. We're not going to be obsessed with inflation until that's so far in the rearview mirror that we really should have been focusing on the car wreck in front of us.
Right, so like a protective cut, and I think we've kind of talked about that a little bit with regard to other economies as well. Do you worry about the potential for fiscal to undermine the monetary at this point?
Well, actually, you know, not in the United States, everything is up in the air because of the election. I don't worry about fiscal being a serious, you know, the U.S., you know, we have not gotten our house in order, but in terms of there being a significant fiscal boost if Biden is reelected, not going to happen. We've sort of done that. If Trump wins, then all bets are off. I mean, he's made it clear that he doesn't want the Fed to retain its independence. He's shown in the past a clear inclination towards kind of Turkey style, you know, print money to help me politically. It's talking about unfunded tax cuts, but also tariffs that are directly inflationary. So no, I have to say markets are way too calm, given that this is a toss-up election, and then one side would represent a huge departure on policy of every kind.
Especially with risks around trade tariffs also increasing. What is the view when it comes to geopolitical tensions arising that could further derail risk assets, not to mention global economies that really have close trading partnerships with the U.S.?
Oh, this is huge. I mean, we are very much, regardless of who wins, we are at the end of an era. I mean, my political science friends talk about hegemonic stability, which was that we had a long era of pretty smooth globalization. You know, things worked because the U.S. was number one, and the U.S. kind of believed in a rules-based order and all of that. And it was always kind of hypothetical. What would happen if we no longer had that? Well, it's gone. Right now we have you know, as long as it was the U.S. and the Euro area, then, well, we share a lot of views, share a lot of values. But with the U.S. and China now as the two big players on the block, everything's wide open. And you know, it doesn't necessarily mean that we descend into a collapse of world trade right away, but it does mean that none of the ground rules that everybody counted on for the past several decades can be counted on anymore.
And here in the Asian economy is really watching this unfold. I'm hearing in Japan now, and what I've heard the rhetoric being is that actually Japan has benefited a lot from the tensions between China and the United States, that a lot of these businesses are now veering towards setting up more connections with Japan. Are you seeing a meaningful demand-driven sort of inflationary pressure that can be sustainable finally in this country?
It's I've been worried about Japan for a long time, and I have to admit that I worry about less because I'm worried about lots of other things, including my own country. I hope so, but I'm not convinced. When I try to look at the Japanese data, I still don't see the kind of fundamental strength. I mean, a lot of Japan's long-term weakness has to do with demography, has to do with extremely low fertility. That hasn't changed, although Japan is at least more open to immigration than it used to be. But it's a long way. I mean, I would say that talk about exiting zero rates. I understand why Japan really wants to be able to declare that we've ended that period, but it's not all clear in the data that it really has.
And yet, what choice do Japanese policymakers have when you have this immense pressure on the Japanese yen? Are you saying that this could potentially be another false dawn when it comes to BOJ policy normalization?
It could well be. I mean, we'll see. I mean, the BOJ leadership is not stupid, to say the least. They're watching this, but I have to say, what puzzles me is why Japan is so worried about the falling yen. It's not as if, I mean, yes, that does hurt consumer prices some, but Japan, as we say, has been a country that has long had a problem in convincingly exiting deflation, and a weaker yen after a little, give it a bit of a lag. That's actually positive for demand for Japanese goods and services. So the thing that I find puzzling is why the weaker yen is inspiring as much panic as it seems to be.
Does it make more sense if you think about the sort of geostrategic tensions, right? Does it create more panic for Beijing, for example?
Oh, for sure. I mean, look, China is in much worse shape. I mean, at fundamental sense, China has a whole economic model that is not sustainable. It has vastly inadequate domestic spending, vastly inadequate consumer demand, has run out of sufficient investment opportunities to keep the economy rolling, but seems bizarrely unable to change its operating, to do even modest steps towards a refocusing on domestic demand. And Japan and China it still seems inclined to try to export its way out, which is not going to happen. The world is not going to accept it. And a falling yen, if you like, adds to that unacceptability, because if there's one thing that we can be sure, it's that the rest of the world is not going to accept a simultaneous Japanese and Chinese export surge on the scale that would happen without some kind of action.
Professor Krugman, it's really great to have you with us. We appreciate your time, and we could continue this conversation, and hopefully you'll join us again soon. That's Nobel Laureate and City University of New York Professor Paul Krugman there.